Hello, everyone. Welcome. We are really happy to see you here. My name is Joyce. I'm your host today. I'm a financial advisor at Saturn Advice. This webinar is brought to you by Saturn Advice. So the topic today is we're going to look at investment opportunities and risks for 2023. And while I am talking away, can I get somebody in the audience to give me a thumb up if you can hear and see us okay? And you can do that using the chat function. Great. Thanks, Jason. All right. So I don't know about you. When I felt pretty positive went into 2022. We finally put COVID behind us. Majority of the world were opening up, and we were finally able to travel again. However, the year ended with the worst bond market in almost 100 years and a broad decline of more than 20% in various share market, and also a decline in property market as well. It just shows me that making investment decision based on the feeling at one moment in time is not a good investment. Is not a good investment strategy. So what's in stock for 2023? We are getting questions from that people we talk to. Some of the investors are anxiously waiting for their investment portfolio to recover, while others are kind of sitting on the sideline with term deposits, cash, and ruminating if now is the right time to go into the market. So in this webinar, we have got a great speaker to hopefully answer these questions and provide a bit of perspective. So that's a segue for me to introduce our speaker today, Shahrukh Abdali. Hello, Shahrukh. Welcome.
Hi, Joyce. Thank you.
So for most of the people on this call, you will be fairly familiar with Shahrukh. He is a financial advisor at Saturn. He also sits on our investment committee. Shahrukh is a CFA Charterholder. He's got a wealth of knowledge, and his monthly market update video is well liked by our clients as well as other investment professionals. So before I hand it over to Shahrukh, I just want to go over some basic housekeeping stuff. First of all, this is for the lawyers out there. Anything we discuss today are general information only. These are not personalized financial advice because we don't know your personal circumstances. And we will be recording this webinar, and the recording as well as the slide deck will be emailed to you next week. So you can play back for the key bits in case you missed something. Last but not the least, we do have, we are open for questions. And to ask a question, you can use the question function that's located at the left-hand side of your screen. And we want to make the session as interactive as possible. So don't be shy, just pop your questions there throughout the webinar, and we're going to try to answer them during and after the main part of the presentation. Without further delay, over to you, Shahrukh.
Thank you, Joyce. Welcome, everyone. Thank you for joining us. Before I go any further, just a quick introduction on who we are. So we are a group of companies specializing in advice, and I sit within the Saturn Advice business that's here at the bottom left. We are experts in giving tailored financial advice personalized to your circumstances as well as needs and objectives. So nothing that I say here is obviously personalized advice, as Joyce has already pointed out. But if you do want to get personalized advice, please reach out to us. We also specialize in investment planning, particularly for retirement, whether it is building a retirement pool, or you are near retirement or at retirement and wanting a roadmap in order to ensure that you can enjoy your retirement without a worry about running out of money. We can do that. We also hold the discretionary investment management license, which is where we have an investment committee in-house that convenes every quarter to look at what is in our investment strategies, any products that need to go out or there is a better alternative out there. Those decisions are taken on a quarterly basis, but obviously minimizing the churn. So that's a very efficient way of managing a portfolio, and only the big players per se in the industry have the license. And we have Saturn Invest, which specializes in UK pension transfers, and then National Capital is our most recent addition to the group. By recent, I mean it has been 2 years now, but they specialize in giving advice for KiwiSaver. The highlight probably is that they do so without costing the signees, or if you were to sign up to National Capital, you wouldn't have to pay for the advice, because a component of the management fee that the fund manager charges is for advice, and you may or may not be getting advice for that component, but National Capital can help. So check it out. The business has been around for 30 odd years, more than 30 years now. Very experienced. We've got offices in Auckland and Christchurch, and between the two offices, we've got the country covered. Probably the highlight of our business model is that we pay a fixed salary to all our staff, including the advisors, and that is really important because as an advisor, when I'm sitting down with a prospective client, my whole and sole focus is to give the best advice that is there without having to worry about making a sale, because there is no sales target for me to achieve at the end of the year. We don't take any commissions from any of the products or the fund managers that we recommend, and neither are any of the staff paid any commissions. All right, now what we'll cover is different asset classes, international shares, Australasian, and then we'll talk about some infrastructure, property, and then we'll close off with fixed interest. On the way, if you've got any questions about anything that you hear or any of those asset classes, please feel free to shoot that out. Now, what are the economic indicators suggesting? And sorry if the slide is a bit small, but I'll talk through it. I've focused on the US, given that it's the largest economy in the world. It's a bit confusing because I have been covering inflation rate for the US and for some other economies for I think 6 months now over my monthly video updates. And as per expectation, the inflation rate has been coming down progressively, which is really good. But alongside, and more so recently, unemployment rate also seems to be dropping in the US. That's a good indication for the economy, suggesting that the economy is in good shape, it's growing, and hence the jobs are growing and unemployment is coming down, which is also reflecting in the consumer spending in that bottom chart here. Consumer spending took a dip in COVID and then rebounded, and since then it's actually been increasing. All of that is suggesting that the US economy is in pretty good nick, but in theory, a growing or hot economy goes hand in hand with inflation, and we want inflation to continue to come down. At 6.5%, it has come down quite a bit from 9.1 mid of last year, but it is still more than 3 times the target, which is 2% for the US Federal Reserve. So what does that mean? And I'll elaborate more about it, but broadly, it's a little bit conflicting. We want the economy to be strong, but hopefully that does not result in inflation not continuing to come down the way it has. International shares, the last, the graph here shows the performance of different indices across the world. S&P 500 is US, Nikkei 25 is Japan, Europe, UK, and then I've got emerging markets there. The last 1 year has been negative all out for pretty much everyone except for UK, just act out a positive return there. But it has been one of those years which happens every few years when pretty much everything falls, particularly the share markets. The last quarter which is the quarter ended December, has been positive for most indices. And I have to point out here that you can see the S&P 500 and Nikkei index returns are negative here. And here I'm saying that the indices actually had a positive quarter, but that's because the returns are in New Zealand dollar terms, and New Zealand dollar really appreciated against most currencies, but particularly the US dollar and the Japanese yen over the past quarter. Hence, despite having positive quarters, both indices report a negative New Zealand dollar return. The outlook, as I've suggested, is mixed. Inflation is receding, but the unemployment rate is historically low and consumer spending is persistently high. At the same time, you've got supply chain that is recovering. I mean, geopolitical disruptions that were paramount, last year with the Russian invasion of Ukraine. It is still there, but supply chains have sort of adjusted to the disruptions and worked way around in some of the affected trade channels. A highlight over recent times is China's zero COVID policy that was there for pretty much the last 2 or 3 years since COVID happened. China was persisting at eliminating COVID, which seemed not practical, and rightly so. They've now shunned away quite abruptly from that policy and have focused on reopening. How that affects different things, I'll talk about that. On the policy front, it is staying restrictive. And here it gets interesting because the unemployment rate dropping and consumer spending persistently remaining high sort of throws out that question that will the policy be even more restrictive than what it is right now, which, if it turns out to be, will be negative for asset prices from here on. But if it stays where it is, then, which is my base case scenario, I think that central bank, particularly the US central bank, is aware of the fact that there is a lag in terms of the impact of monetary policy showing up an impact on economic indicators. And they went restrictive about a year ago, and it's beginning to have an impact, obviously, on inflation. But the economic indicators, the slowdown in the economy, will start to happen as we progress further in this year. So hopefully they are not going to incur a policy error by again going further restrictive from where they are already. It's pretty restrictive with interest rates at 4.75%. I think there is an expectation of a further 1, maybe 2 interest rate hikes, but I think they'll stay the course from there on and wait and see if the economy starts to slow down, which is in a way necessary to ensure that inflation structurally comes down. Now, what is the impact of this restrictive policy? We've seen the first impact, which is the negative impact on asset valuations. Interest rates going up negatively affects asset valuations, and we saw that last year. The next secondary impact is on business earnings, which is the key from here on. If the earnings decline worse than what the market has already priced in, mind you, market is always forward-looking, so there is an expectation that earnings will decline. But if the decline is worse than what is already priced in, then there is room for the markets to fall. Now, I'll also mention here my personal view that a month ago or end of last year, the markets were pretty down, and this year has been quite materially positive. January was one of the most positive Januaries in a while, and February so far is also positive to add on to January. So it should be noted that most indices around the globe are now off their October lows by a good 15%. So that's sort of given that room if the markets were to see any negative news come out, which wasn't expected, there is room for the markets to fall. So that's the baseline expectation. On terms of recession, there is a lot of question that I get asked about, whether there's going to be recession or not. I think there is going to be a mild recession across most economies, but it's going to be to varying degrees. The US, for example, with the strong economy that they have, it is possible that they are able to, the best case scenario, avoid a recession totally, or have a really mild recession, which does not really get into a deep, prolonged one. But then there are other places which have more indigenous factors affecting the economy. In New Zealand, for example, we do have the problem of labor shortage, which is something that I'll talk about on the next slide. But base case, mild recession, and I say it's a mild recession versus a deep recession because central banks have created that buffer of being restrictive, and they can dial down the restriction if they feel that the economy is tipping into a deeper recession. They can drop the interest rates a bit and maybe ease up on the quantitative tightening a bit to allow the economy to get back on the economic cycle uptrend. So that's why I think that it's not going to be a deep recession. Now, what opportunities are there in terms of investment for the listeners and for investors in general? Look for businesses with pricing power. So utilities is a pretty safe bet. They generally do have sticky revenues, as well as have the pricing power to pass on any inflationary impact onto their consumer. Luxury brands is also defensive in this nature. Typically a buyer of Ferrari is not going to be bothered if the price of Ferrari goes up by 20, 30 grand. They'll still buy a Ferrari. So inflation can be passed on by luxury brands onto their consumers. So those kind of businesses will fare well in the present environment, which is still, inflation is coming down, but it's still pretty inflationary. Non-cyclical businesses are quite defensive when it comes to recessions or an economic slowdown. Think supermarkets or healthcare businesses. Both of these types of businesses will see quite sticky, consumer activity, irrespective of what's happening in the economy. And finally, look for quality businesses in beaten down sectors. For example, technology. Technology companies are down by a good, they've recently had a bounce given the markets have rebounded, but at the worst of it, they were down 60-70% from their pre-decline peaks. So they were beaten down quite a bit, and I expect that quality businesses, high cash flow generating businesses within that sector will rebound really strongly whenever the market turns, which is probably the key question, but don't know yet. I've got some views, but we'll talk about it. Risks, stay away from commodity businesses. Energy has had a good run in the last year, given the oil price was pretty high, but as I had written in my markets commentary, I expected the oil price to normalize from the highs, multi-year high that it achieved, and it has come down. Has been slightly boosted with Chinese reopening, which has boosted the demand for energy recently. So that has given some sort of lowering to energy. But in general, whenever there is an economic slowdown, demand for energy falls, and I would expect the price of oil to see some headwinds, and accordingly, energy businesses will see some subdued revenues as a result of the economic slowdown. Also, consumers drop their spending on discretionary items like automobiles. So cyclical businesses like automobiles will see reduced activity when there is a recession or an economic slowdown. And also banks will see subdued revenues amidst economic slowdown, because not as many people will be taking out personal loans. New mortgages will, activity on new mortgage front will fall. Businesses will also go into contractionary mode, so they won't be taking out new business loans. But as I said, markets are forward-looking, so they have fallen ahead of all these risks materializing, and the oncoming recession has, to some extent at least, been priced in. And the post-recession rebound may start before the worst of recession actually happens. So do not think that once we need to first come out of a recession, go into a recession, and come out of it before the markets can rebound. The typical scenario is the markets will rebound before we get to the bottom of the recession. Before I go on to the next slide, Joyce, any questions? You're on mute.
Thanks. Can you hear me now?
Yeah.
Okay. So you've talked about beaten down sectors such as technology. Here's a question from Peter that's quite relevant. And the question is, can you tell me when Ark is going to reach historical high again? And to give a bit of context, put a bit of context around it for our audience. So Ark here, we're referring to Nico Ark Innovative Technology Fund. That's growth-oriented. It's a satellite strategy in our model portfolio, small percentage, which was beaten down quite hard last year. And that investing disruptive technologies, as the name suggests. Over to you, Shahrukh.
Thanks, Joyce. Sounds like someone's having a dig at me. So Ark, firstly, let's understand what exactly happened with Ark. So it was where it was during the depths of COVID. It shot up 5 times nearly over the next 12, maybe 18 months, which was unsustainable to start with. I mean, it was just bizarre the way it went up. So from those highs, obviously, as things turn, interest rates started to go up. It had to come down because interest rates affect asset valuations, and particularly valuations of businesses that are not generating a lot of revenue present time, but are expected to generate a lot of revenue in the years ahead. So you discount those future cash flows and revenue down to present dollar terms by applying a discount factor, and that discount factor is directly related to the interest rate prevalent. So when that discount factor goes up, the valuation of those future earnings comes down, and hence Ark and similar sort of fund managers which are focused on high growth companies got hit pretty hard when interest rates started to go up. Now, having said that, my view right now is that interest rate hike cycle is nearing an end, which means that most of the downside has been seen. And while there may be some more volatility, I mean, that's the nature of investing in high growth companies, I expect the future upside is a lot more significant from here on. As to when exactly Ark might re-achieve its previous highs, I don't know, but I'd say they have a 5-year view, and I'd stick with that. Short of any fraud that I'm not aware of, I have absolute faith in the type of research that Kathy Wood and her team does, and I believe that they will be able to provide some really above market returns over the coming years.
Thanks, Shahrukh. That's it for now.
Okay, all right. Right, Australasian shares, it's primarily Australia and New Zealand. On the graph here, you can see New Zealand NZX 50 index and ASX 300. NZX 50 had a positive quarter, and so did ASX 300, but I would point out that ASX 300 actually had a significantly better quarter than New Zealand, but the return in New Zealand dollar terms is sort of at par with what the New Zealand exchange has provided. And that's again to the fact of New Zealand dollar appreciating against the Aussie dollar. Now, the outlook for both New Zealand and Australia is that of consumer spending, which is strong, which has been strong, is going to soften over the coming months as the economy cools down and the restrictive stance, particularly in New Zealand, starts to bite. And the basic reason for that is the negative wealth effect, which is going to be a combination of declining house prices and higher mortgage payments. I forgot the percentage of the mortgages that are due for renewal this year, but it's a pretty substantial percentage that is going to get renewed, and we know that mortgage rates have tripled, from a year ago, which is going to start to hit the disposable income for consumers. And that, in combination with declining house prices, a lot of wealth for the typical consumer, both in New Zealand as well as Australia, is tied to property. So if the property price is going down, it has that impact on your mindset that you are less wealthy, and that is going to constrict the spending, which is going to slow down the economy. In New Zealand, RBNZ appears to be more restrictive than Reserve Bank of Australia. Actually, Reserve Bank of Australia pivoted to being less restrictive recently, which was a bit of a surprise for everyone. But RBNZ actually upped their NK in terms of being restrictive and hiking the interest rates. They were previously doing it at 0.5%. Every meeting, and then the last one they did 0.75%, with the indications that further similar rate hikes will happen down the road. So what's that going to do for the New Zealand economy? Higher interest rates obviously are negative for asset valuation, so I would expect more headwinds for asset prices in New Zealand. And New Zealand has obviously got its labor shortage, as I've pointed out earlier, which is feeding into wage inflation. Businesses are struggling to find people, and that is going to stifle their profits further. So in combination with a slowing economy, if your profits are stifled from wage inflation, that's not really a good scenario for the businesses and for the economy in general. So New Zealand economy, I think, is in for a rougher ride relative to, for example, the US economy. Australia's heavyweights in terms of banks will see reduced revenue during recession. I've touched upon this, what happens for banks in a typical economic slowdown. And then there might be also reduced demand for mining due to the slowdown. But China's recent reopening will provide some sort of support, and the demand will recover, at least for the mining resources. But in general, over the medium term, Chinese government is moving away from it's focused on urbanization and property sector. So I think overall the demand for the mining resources for Australia is going to be at risk over the medium term. Where to invest? It's the same thing. Businesses with pricing power and non-cyclical businesses are the place to be for Australia as well as New Zealand. Any questions, Joyce?
Yeah, Shahrukh, there is a pre-submitted question from Jack. Are stock markets likely to pick up in 2023, even with the recession in bond? I know that you sort of touched on that previously already, and you kind of highlighted that New Zealand is in for a rough ride, and different economy is probably going to recover at a different pace. So maybe when you try to answer this question from an angle of put your IC investment committee hat on, from an asset allocation or how do you design investment strategy perspective, how should investor do in this kind of environment?
Yeah, we've pretty much alluded to what I was going to say. So that's exactly right. Different economies are going to have a different outcome over the coming months in terms of the level of economic slowdown that they experience, and hence the performance of the investment assets domiciled within. Accordingly, it is very, very important for an investor to diversify, not just across different types of industries, but across different geographic regions. And that's where we come, obviously, in play. We specialize in formulating strategies which are diversified all over the world, across different asset classes and different industries. So that's what I would be suggesting. In terms of when exactly we are going to see the pivot in share markets, I don't know. I wish I knew someone who knew this. But I would say that probably expect heightened volatility until maybe May. And the reason I say May is the earnings for the first quarter, the earnings guidance is coming out these days, and it's coming out leaning towards the positive. They're beating the expectations, hence the market is also sustaining an up journey. But come April, May, earnings announcements will start to come for the second quarter, which is the guidance for the second quarter and the results for the first quarter. If those earnings expectations are lower than what the market has been expecting, then we could see the market slide down. On the contrary, if any macro picture changes for the worse, the markets can slide down. For example, if the US Fed suddenly changes tone again and goes hawkish, which is being more restrictive, that can also trigger a sell-off. Or if they stay pretty mellow on their narrative and say, like, we've done what needs to be done and we will stick to the current interest rates, that can be supportive. And if the earnings then start coming out better than expectations, then the markets will bounce. But between now and then, there will be volatility, and volatility is not just downside volatility. Volatility is upside as well. So we weren't expecting January to be as positive as it was, which is also volatility on the upside, and then there could be further downside over the coming a few weeks or months. Beyond that, once we are nearing a recession or an economic slowdown, I think at some stage markets will start to look past a recession even before the pain really hits the main street. And beyond that, typically an economic cycle lasts about 5 years on average. So I would expect the performance of investment assets, particularly the share markets, to be pretty strong for the following few years.
Great, thanks. Actually, I'm going to give you another one.
Okay.
That's changing tack a little bit, but it's more of a when the rubber hits the road kind of question. What should I do in this specific scenario? It's a question pre-submitted by Tony. Tony, I know you are on the call. There are some numbers involved. Basically, and Tony says, I'm a conservative Kiwi saver. I'm in conservative Kiwi saver scheme. Started 2022 with a balance of X amount during the year, employer and him contributed. But basically by the end of December, his balance was slightly higher than the original balance. If you take into account the contribution, he's actually lost 11,500. So he's 70, still working. And his question is, should I withdraw and invest that along with my monthly contribution into an interest earning investment account with the bank?
So investment earning accounts with the bank, I would potentially say he's leaning towards term deposits, which are beginning to look relatively attractive, offering about 5, maybe 6% rates against, over the next, against the share markets, which have been falling. So it's obviously quite an attractive proposition, but those are the rates that you can expect to receive going forward. And if, over the next 5 years, we can't beat what the term deposits can pay you, what's the point? So I am going to suggest to Tony that, he stay the course. Did you say he's in conservative? Yeah. So conservative going backwards can be a bit confusing, but fixed income have had a tough time the past year, given that even fixed income is valued, the asset valuations for fixed income assets are also affected negatively by interest rates going up, and the interest rates have really gone up. So despite being in a conservative strategy, you would have seen negative returns. But from where we stand right now, as I said, there could be some volatility down the road in the coming months, but longer term, medium to longer term, I would expect some really good returns. Now, I would also take this opportunity to point out that for someone, the age of retirement, or 70, I think that's what you said for Tony, you might argue that, but I am already at that age group where I shouldn't be looking at growth assets. I would argue against that because the investment time horizon is actually much longer. So, even if you're 70, it could be another 10, 15 years ahead for you in terms of your retirement, that you are looking to extract an income. And if you're looking to invest for 15 years, well, 15 years is a long time to stay defensive or, have a growth exposure, because 15 years, the growth assets will run their cycle, and the short-term volatility will pan out. And beyond that, I mean, think about legacy assets. If you are wanting to leave something behind for the next generation, the investment horizon is probably infinite then. So don't just think about going into cash or conservative if you're retired or around that age, because the investment horizon is still pretty long.
Thanks, Shahrukh. Tony, hope this helps. And this is our jam. Let us help. If you want to have further discussion, just get in touch with us. Shahrukh, please move on.
Okay. Next, I've got infrastructure. And by infrastructure, let me highlight what I'm talking about. So typically, infrastructure assets would include toll roads, bridges, airports, railway network, utility infrastructure. Then there is the power grids and the transmission network, and then there is the energy infrastructure, which is obviously the logistics of related to the energy supplies. Those kind of assets have relatively defensive traits compared to other types of growth assets. And what has been happening within the infrastructure, international travel obviously shot up post-COVID. And I've pointed this out in my monthly update that I expect the international travel to normalize from the pent-up demand that we saw over the recent months, and we're still witnessing to a fair extent even now. But I would expect that this international travel is going to normalize over the coming months, particularly so when the respective economies around the globe start to slow down. People will restrict international travel to sort of hunker down through the slowdown, the economic slowdown. So airports will continue to see reasonably good aeronautical revenues. However, there will be some slowdown further down the road as the economies start to slow down. Road traffic is expected to be stable. I think China was probably the last one to continue to persist with a lockdown strategy. I don't think unless there is a significantly fatal new strain of COVID that starts to spread across the globe, I can't see anywhere in the world, the government trying to put their population into another lockdown. So I think road traffic is going to stay. More so, there will be people looking to avoid public transport for now. I mean, that this trend is probably fading now, but still I see people preferring to drive rather than ride a bus to avoid exposure to COVID. Energy infrastructure will see suppressed revenues, as I said, the demand for energy goes down when there is an economic slowdown. So I would expect that while energy revenues are still reasonably good, and at least for now, the demand from the Chinese reopening is there, I would expect over the coming months, as the global economy slows down, the revenues will be suppressed as oil price also sees some headwinds. Utilities infrastructure offers pretty defensive traits. As I've said, utilities is part of that sector which can pass on inflationary impact to their consumers, as well as their demand is pretty sticky. You wouldn't really cut off your water supply or stop using electricity if you are having some trouble with the economic slowdown. So utilities infrastructure is a good space for investors to look at to achieve stable dividend yields, particularly as the economy slows down. In general, I would say infrastructure is the more defensive type of growth asset compared to other growth assets. Any questions, Joyce? No? Okay. Next, property. And property largely here, I'm talking about listed property. So property assets that are listed on share market. And the graph here shows the return over recent times. It has been a really tough 3 years since COVID happened for property. And you can see the returns even for the 3 years have fallen into the negative side for New Zealand as well as global property. Australian property is marginally positive on the 3 year return, and that's largely down to their quarterly return being quite significantly positive. And the quarterly return for Australian market was significantly positive, as I said, from the Reserve Bank of Australia. They surprised with a pivot towards a less restrictive stance, which boosted the valuations for property assets. All asset valuations are affected by interest rate hikes, and if the central bank takes a less restrictive stance, that is a boost for valuations. But higher interest rates are negative for valuations. So interest rates are definitely higher than where they were, and for New Zealand at least are expected to continue to rise, given that inflation here is going to prove to be stickier than elsewhere. So for New Zealand property assets, I think the headwinds are still going to be there. But in general, I think we are coming to the end of the hike cycle, which means that the headwinds for the valuations for property assets are fading. The drop in valuations over the past year or past 2-3 years means that the dividend yields from property assets has gone up because typically the dividends that are getting paid out are relatively stable for listed property companies. However, as the economic slowdown starts to bite, there will be some downside to the yields because the rental yields will get affected as lease renewals will get affected. Businesses will fail and may not be able to pay the rent. So, but in general, most of the listed property assets are pretty diversified. So the yields on these assets have just gone up because of the downside the valuations have seen. Within each, within the listed property space, the subsectors office will continue to see a hybrid approach. And a hybrid approach is a combination of working from the office as well as working remotely. I would caution against the thinking that remote work is the future. There will be hybrid, so the efficiencies are definitely there in terms of some better lifestyle for employees and more satisfaction for employees if they are able to work remotely at least part of the week. But I don't think that we are going to continue to see an increase in remote work as seemed to be the hype a year or 2 years ago during COVID when there was a lot of news items suggesting that there are people working in exotic locations, by the beach or wherever, and in different time zones. I don't think that's a sustainable trend. If at all, I believe that there will be, a return to working at the physical office, not simply because the employers want their employees back in the office, but also from the employee's point of view. I mean, as humans, it's in our nature to interact. And if we are constantly looking at a screen for our interactions, that starts to have an impact. So I think you will see more and more employees wanting to be back amongst their colleagues, at least for part of the week. Now, industrial subsector will continue to see strong demand for warehouses and logistics assets over the medium to long term because of the advent of e-commerce as well as the supply chain disruptions that highlighted some bottlenecks. So, businesses are more prudent in terms of their inventory management. But over the short term, I think revenue will see some headwinds due to the oncoming economic slowdown. There will be less economic activity, and hence the revenue for the industrial assets will get affected. Same thing for hospitality. In general, I think an economic slowdown affects people moving around, staying in hotels and spending money in the hospitality sector. But in the near term, tourism has picked up in New Zealand and Australia due to summer, as well as the borders are open. I just went for a holiday down in South Island, and I could see quite a few tourists. So I can vouch for that. I think tourism is definitely picked up. But there will be some subdued revenues later in the year and into the next year until we get out of the economic slowdown. Retail will have headwinds near term from the economic slowdown, and in the longer term, it is key to not be associated or invested in businesses that are or invested in property stocks which are focusing on businesses without an online presence, because e-commerce is going to continue to progress. There was a very quick uptake on e-commerce during COVID. Everyone got introduced to it, irrespective of the age group, I think, and that trend is going to continue to progress. I've also included New Zealand residential property here, as that seems to be a really hot topic for clients as well as pretty much everyone I talk to. Higher mortgages now, new tax laws that are now taking place, particularly the interest deductibility is getting phased out. Tenant-friendly policies that were introduced by the government have increased the headache of managing properties for landlords. Lack of migrants. Now, migrants got stopped in their tracks because the borders were shut in COVID. But even with the borders open now, I do not expect floodgates to open in terms of migration, simply because being a migrant, I know that you need to go to a place where there are a lot of opportunities for you to grow as a professional, as well as be able to buy your first home and settle down. So New Zealand, being a small economy, I think is not really up on that list of offering jobs apart from one or two sectors. And with the prices where they have gone to over the last decade, it's really, really hard for anyone to look to buy a house coming into this country. So while there will be some migrants coming in, I can't see the highs of 2015, 2016, 2017 to return, where net migration was positive 70,000 or north of that a year. And without the migrants, you've also got the skilled young Kiwis who returned from overseas during COVID, looking for overseas opportunities once again. So you have those outflows in terms of Kiwis, and then that in combination with investors looking to offload their loss-making properties due to the phasing out of interest deductibility, higher mortgages making it tough for new property owners. I think there are a lot of headwinds for this property market, and the only silver lining is probably this year's election, where if National comes to power, they may tweak some of the tax laws or make it slightly better in terms of tenant policies or something like that. But that, if they think along those lines, it's going to be a really politically charged move. So I can't see that the base case scenario. The base case scenario is this property market is unlikely to see any capital gains for some time. Could be years. Any questions?
Not from the audience. A follow-up question from me on residential property. So, all these things that you had on the slide are factors that's influencing the residential property market. So the best case scenario that you mentioned earlier, if this year's election, let's say, resulting reversal of the new tax law, what kind of impact, or how much of an impact you think it's going to have on residential markets, residential property markets?
Well, at least it's not going to fall any further. I would say if there is any tweaking of the tax laws that's going to make it more attractive for the investors, well, you will see increased investor demand, uh, which is going to sort out the current fundamentals, which are certainly pointing downwards. But as I said, like, this property market is already one of the most expensive in the world. So uh, fundamentally, that doesn't change anything apart from those with a lot of equity, whether that's in other investment properties or in their own houses, will have the opportunity to buy into this property market. But for new first home buyers, I think it's going to remain pretty tough. But as I said, like, my base case scenario is it's unlikely that this property market is going to improve for the foreseeable future. It will be potentially years of flat, maybe slightly declining property prices before things change, because wages need to come up significantly to bring the income to price ratio back in line with the global standards. It's currently way out of whack.
Yep, thanks, Shahrukh. I guess for property investors, it's important to think about return on capital, right?
Yeah.
No more questions. Move on, please.
Okay, international fixed interest is investing in bonds globally, and it's had a positive quarter, which is a really pleasant change from the negative quarter after quarter that we have seen over the past couple of years now, almost. Last year was significantly negative, which is not something that I can recall happening in my working life. But even my colleagues who have been around for decades can vaguely remember something like that decades ago. So this isn't something usual that we saw the last year. And to Tony's point, being invested in conservative, you still got a negative return. Couldn't avoid it with the interest rate hikes that we saw the last year. Going forward, the hiking cycle is coming to an end, which should ease the valuation headwinds. At the same time, you will see bonds beginning to offer yields which are respectable for the first time in many years. And they are expected to improve further because the impact from the hike cycle is yet to fully reflect the bond yields going up. Which means that the asset class is again beginning to offer diversification benefits, reasonable as well as improving yield and lower volatility compared to shares, particularly the short-term volatility for shares, which has been quite high over the past year or so, and it is expected to be high over the coming months. It would be a good idea to have some international fixed interest exposure within your portfolios. Any questions? All right, New Zealand fixed interest. It has been negative, for the obvious reasons that I've mentioned out. But again, the quarter has just turned the corner, it seems. I will caution for New Zealand, as I said, like, RBNZ is seemingly more aggressive relative to its peers globally, which means that the headwinds for New Zealand fixed interest still remain in terms of valuation, and the indigenous factors may not allow inflation to fall quickly here in New Zealand, which is again going to feed into RBNZ's determination that they will continue to be really restrictive until inflation falls closer to the target. Well, they say within the target, but I expect that once it falls to somewhere close to the target, that should be enough impetus for them to ease. So why would you invest in New Zealand bonds? Because of the drop in valuations and the yields improving. The yields, the coupon payments are beginning to look attractive again, and they are expected to improve further. And despite the falls that you've seen in the valuations for New Zealand fixed interest, they're to the tune of 6% or 5%, while the share markets typically can fall in a year up to 20% or thereabouts if they've got a really bad year. And this was a really bad year for fixed interest. Outlook for the New Zealand dollar, well, the near term depends on the respective central bank policies. I've said the New Zealand dollar has really appreciated against most currencies over the last quarter, and that was because RBNZ remaining really restrictive and focused on raising interest rates at a really rapid pace versus other central banks. And if they maintain that and the other central banks continue to slow down or stop raising interest rates, we might see some more strength in New Zealand dollar. But beyond that, it is going to be, the economic slowdown, which initially at least is going to be good for the safe haven currencies like the US dollar or the Japanese yen. And then beyond the economic slowdown, once you start to come out of the economic slowdown, typically commodity currencies like New Zealand dollar, Australian dollar, see some strength. Any questions? No? Right, so that was that for the asset classes. I'll just wrap up with a holistic view for the investor. So, I've talked about different asset classes and the respective opportunities within and why you should be investing in one or the other or each of them. But it is really important to achieve diversification by investing across different asset classes and across different geographic regions, as is the case, shown here. If you are investing in just one of these baskets, well, you're really concentrating and putting your eggs in the baskets in one basket, but you should be spreading yourself across all. And the easiest way to do so is through managed funds, because managed funds are able to invest, across all these baskets in fraction values. If you were to spread your money across all of these, property is probably going to take up most of your capital. And if something's left over, you'll be dabbling into some direct shares and bonds and then some private business and then something in term deposits. But mostly it will be pretty chunky investments. Easier ways through managed funds and then across geographic regions. Diversification is important because, if you were to invest in just one type of asset, you will be riding the cycle up and down. But if you're investing in complementary type of businesses, your journey is a lot smoother, and it's not going to be a straight line, but that's a general picture. And lastly, I've got this chart here which I have shown in my monthly video updates, which shows the US share market going back 80 years. So this cycle that we are experiencing right now, part of that is shown here. The US share market is, you can't probably see the numbers, but I can tell you it's about 20% down on that graph, and that was roughly the worst of the S&P 500. I think it went down by 24% at the worst of it. So that is what the downside was for this year. And you can see these yellow valleys have occurred quite regularly over the past 80 years. So it isn't something that is new. It keeps happening every 5 to 8 years. Every time it is followed by a uphill journey, which is going to be a lot longer and a lot stronger. So this time still is no different. Once we are past this current turmoil, I am very confident that the markets will have this uphill journey from here onwards, which is going to be for a few years, and it'll be a lot bigger than the downside that we've seen recently. So hang in there for those who are invested, and for those who are sitting on the sidelines, good time to buy.
Thank you, Shahrukh. Yeah, bear market is certainly a temporary and common occurrence.
Yeah. Any other questions that you might have later on, please reach out to us. Those are the details for the business as well as myself.
Great.
Over to you, Joyce. You can do the concluding remarks.
Yep. Thank you, Shahrukh. It's always great listening to you. I've given you, sorry for putting you on the spot. I've given you a few crystal ball questions and you survived that. For our audience out there, thank you for spending the last hour with us. We want to be respectful of your time. We will wrap it up. Now, you are here for a reason, right? You don't spend an hour with us just for fun. You might have doubts, you might have questions, maybe you just need reassurance for your investment, or you need help with your investment planning or financial retirement planning. Like that's our jam. So just get in touch, let us help you. I'm just gonna bring up a poll. Let's see if it works. if you need help with investment planning or financial planning, click yes to book a 30 minutes free consultation with Shahrukh. That brings us to the end of this webinar. Thanks everyone, and have a great weekend. See you next time. Bye.